So looking ahead to the week starting October 14th, pretty much two things to focus on. One is the EU summit, and that's pretty much the last hurrah for whether we can get some kind of Brexit deal between the UK and the EU, of course. And then it's the beginning of US earnings season. Before we discuss all that, we'll run through some of the major economic events for the coming week. But just to give you a quick rundown on what's been going on in markets, for equities, it's been a little bit choppy because the focus has been very much on the trade war. The trade war could play a role at the start of the week because we'll know whether the US is implementing more tariffs on China. But earnings season should take a precedent moving after that once we have some kind of resolution there. For the Forex market, there's been some talk about the US and China having some sort of currency pact. If that's the case, that should be positive for the Chinese yuan and negative for the dollar. And we've seen the dollar weaken against other currencies. We've seen a big push higher in the euro, and then helped by the fact that Brexit negotiations seem to be going well between a meeting between Boris Johnson and Leo Varadkar, the Irish Prime Minister. The British pound has been doing well against the dollar too. Oil prices, they've been pretty weak for the main part, but did get a bounce because of a strike on an Iranian oil tanker at the end of the week. And gold prices have fallen off somewhat because there is, again, a bit more optimism, firstly about Brexit, but also about the US-China trade war. Now let's get into that economic calendar for the week. So worth noting that it's Columbus Day on Monday, so some US markets will be closed. We have politically sensitive Chinese trade balance data coming out, as well as Chinese inflation. Those two will be worth watching, especially depending on how the tariffs get implemented in the US. UK unemployment, I don't think will be such a factor because of the importance of the EU summit. German ZEW, that will be important to watch. We're expecting a big drop in business sentiment in Germany, given the weak economic data that we've seen of late. Inflation data from the UK and the Eurozone, again, since the ECB have already promised to start quantitative easing, I think there'll be less focus on that this time around, but certainly could contribute towards further euro-dollar strength. And we also have the Fed beige book. That'll be interesting because obviously there's been recession talk in the US, so it'll be interesting to see what these regional Fed banks think about the different regions of the US. So now just to discuss this upcoming Q3 earnings season, if we look at the S&P 500, obviously the top 500 companies in the US, the expectation as we currently stand is for a minus 4.1% year-over-year decline in earnings. And so if that were to actually take place, that'd be the third quarter in a row where we've seen that decline in earnings. And so it's something of an earnings recession, and we haven't seen something like this since 2016. So clearly a bit of a general disappointment about how earnings can be taking place is a possibility for markets. Very simplistically, the S&P 500 is actually valued around the sort of highs, above average highs in terms of valuation, so slightly overvalued, and earnings are declining. So that's actually a bit of a toxic mix for long-term investors deciding whether to put money into the stock market. So this earnings season, potentially a downside risk to what happens in markets. Now, we know that obviously companies issue downward guidance as we move towards the earnings season, so that helps them beat this lowered guidance later on when they actually release results. So bearing that in mind, it's probably not going to be a minus 4.1% quarter, but it's likely to still be a negative quarter. And again, that runs into those 3 successive quarters of negative growth, which is, we think, a negative factor for the stock market. So then you're looking to other factors like interest rates being lowered as positive factors for equity markets to be able to keep moving forwards. If I dig into the details of this a little bit, you can maybe think that actually things are not quite so bad as they seem on the surface, because actually a lot of these losses in earnings are being led by the oil sector because of the decline in oil prices, as well as basic materials. That's mostly because China, the big consumer of basic materials, is in an economic slowdown and obviously in this trade war with the US. So particularly if we've got some kind of resolution on the trade war, at least partial resolution, that may ease some of the expectations about these basic resources companies, which at the moment are expected to have worse earnings than in previous quarters. Now let's switch gears to the EU summit. The point being here that really something needs to happen at this summit for there to be some kind of Brexit deal before the October 31st. We learned from court papers in Scotland that if there isn't any kind of resolution, it looks like Boris Johnson will most likely ask for an extension around October 19th after this summit. So the way this boils down for the British pound is that really probably both scenarios are quite positive. One is that some sort of deal does magically take place. Somehow the UK and the EU are able to get through their differences about the Irish border and actually some kind of deal takes place. That's a net positive. Or there's an extension, and at least both of these scenarios relieve the possibility of a no deal exit. So only if there's some sort of some master plan of the Johnson government in the UK to still take the UK out with a no deal at the end of October, only under that scenario do we see some kind of more drastic negativity towards the pound. And indeed, at the end of last week, we saw one of the biggest daily jumps in the pound in 7 months. That kind of shows the kind of optimism there is towards the currency at this stage, given that all this is taking place with the Brexit negotiations. And just one last thing to mention before we round up the video is that we don't know at the time of recording whether the US will in fact impose a new set of tariffs on China. If that happens, it's going to be a negative for risk sentiment. If it doesn't, if somehow there's a deal or at least a delay to these tariffs, then that should be a positive way to start the week for equities, and probably for safe haven assets like the dollar and gold, it wouldn't be such a positive. We'd likely see those assets decline. Right, thank you very much for watching this video, and of course if you do enjoy these videos and get some benefit, make sure to follow myself and LCG on YouTube and social media.